Welcome, everyone, and thank you for joining us for today's episode of Horde's Dairyman Dairy Livestream. I'm your host for today, Caitlin Allen. I'm an associate editor here at Horde's Dairyman. We have an interesting episode planned for you today as we talk through federal orders and their function. And we're happy to have our friends at Diamond V sponsor this episode of Dairy Livestream. Today's guests are our three regular commentators here on Dairy Livestream, Mark Stevenson, Andy Novakovich, and Chris Wolf. And today we'll be diving into some of the modern stress points on the federal order system and a bit of why they've arisen. We do have a question panel there in your go-to webinar control panel that you guys can drop your questions in, and we will bring those up to the panelists throughout this hour. Today's discussion is intended to be kind of a broad scope of some background and some of these issues, and we're hoping for some future episodes to dive a little deeper into a few of these topics. Before we go to our first guest today, we can go to a poll question if Jim would like to put that on the screen. When did the dairy industry first use classified pricing and pooling? Your options are 1896, 1933, 1937, or 1961. This will be some interesting responses to talk about while we're going through this. A lot of about evenly split between these options. We can go ahead and close that poll, Jim. Most people saying 1937. And we'll dive a little deeper into that in our next few guests. Our first guest today will be Mark Stevenson. Mark, can you walk us through a few of the issues that we've had and seen with the federal order system and what they mean for dairy farmers?
Well, I'd be happy to, Caitlin, and thank you. I think this is an interesting topic, and in fact, probably so interesting that there's no way we can cover everything that we would want to in a 1-hour session. So our plan today, as Andy and Chris and I have talked about it, is to try to look at this maybe a bit more broadly. So we're going to try to go wide and maybe not deep today. And on subsequent live streams, we will try to take a particular topic and go deep. And the reason that we thought we'd start off here going broad rather than deep is because you have to think about a federal order system as being a full system. If what you try to do is identify any one issue and topic and say, look, it's too complicated to think about the whole thing. What we want to do is focus on one little issue and let's solve that as a problem. You may end up breaking the system because every piece impacts some other piece of a federal order system. And, I'm going to give you just a few highlights of what I think some of today's issues are. And honestly, if you would have looked at this 4, 5, 6 years ago, this would not have been any kind of order that you would have given these issues in. They would not have been something that would have been common, but they are the issues of the day. And I think that you have to start out with one that's kind of a screaming issue for us, and that is negative PPDs in my milk check. I've tried to explain it to people in writing, in Horde's Dairyman, among other places, where the PPDs are calculated from. A federal order system does a couple of different things. One of them is how do we collect the money or the funds, and that is from the processors who are paying into that, and then how do we distribute those monies and funds, pay that out to producers. We've chosen to pay those out in class 3 component values, and usually, historically, there's been some money left over in each of these pools that we've had, and we pay that out as a PPD. So that extra money that's paid out after components gets distributed back to dairy producers in terms of the volume of milk that you've actually sold. If we have an opportunity to pay out more in components in class 3 than we've collected in the entire pool, then at that point in time, we have negative PPDs. Now, usually those PPDs have been negative and annoying. You know, they've been 50 cents or $1 maybe, and that was a big one. But we've seen $8 negative PPDs, and that starts to feel like that's a problem. It's mostly an accounting exercise for us, but it's in rub. So that's an issue today. Now, part of the reason that we have a problem like that is because we've got a lot of price volatility. Prices are moving up and down quite rapidly. And I would say that that is something that can be another problem. And maybe Andy can talk a little bit more about some of these kind of ideas when he's discussing his part of today's program. But in some way, shape, or form, people are telling us that federal orders ought to solve that problem of price volatility for us. How can we do that? Well, it may be possible, but it maybe currently isn't what we're asking federal orders to do. The other thing, of course, that federal orders do intrinsically is to discover the value of milk price discovery. Every month we get an announcement that tells us what the class 1, 2, 3, and 4 prices are, and those are what plants are paying. Now, price discovery becomes a bit of an issue. Back in, what was it, 1998, Andy, 99, we worked with a couple of teams of university officials to look at some pretty big issues in federal orders back then. And one of those big issues was, what do we replace the M&W, the Minnesota-Wisconsin price series with? That's how we were discovering price back then. We surveyed plants that bought grade B milk, which wasn't eligible in the federal milk marketing order. And we said that's a good starting point for prices in a federal milk marketing order. But when we had to move away from that, we chose a different path, and we now use product price formulas. So one question that I hear people asking about is, should we think about a different way of discovering those prices? It seems to be very volatile now. And are we really getting the right price? Is this reflective of what the market value of milk really is? Then, of course, and this relates somewhat to our negative PPDs I talked about, but it is a slightly separate issue, and that's plant depooling. I know that a lot of dairy producers get annoyed when they see plants that are in the federal order system, when it's advantageous for them to do that, and when it looks like it's not going to be advantageous, they jump out. And folks are saying, well, you know, is that really the way we ought to operate a business like this? You know, that in and out, in and out. No, you should be in and pooled all the time. So plant depooling, I think, is another one of those issues. Currently, the way we discover prices is with something that we call product price formulas. And those formulas have to allow dairy processors some means of transforming milk into the products that we are using in the product price formulas. And there's a number in there called the make allowance. And that make allowance hasn't been changed in 10 years. And I think if you ask dairy processors, have your prices, your costs other than milk, been stable over a 10-year time period? They'd say no. Labor's gone up over that time period. Utilities perhaps, and some other packaging, other major costs. So there is a need to look at these make allowances in the federal order formulas if we're going to use that as a means of discovering price. Finally, I don't hear people talking about it much, but class 1 price differentials have often cropped up as being a major point of discussion in federal orders. Is it time to look at that? Are our price relationships the same as they were 20 years ago when we set these prices? In fact, should prices be different anywhere across the country, you know, in terms of a class 1 differential? And then I think the last one I'm going to throw out, there are plenty more issues we could talk about, but it's timing. So our class 1 prices, processors, and a portion of the value of class 2 milk gets what we call advanced pricing. they get to know what their milk price is going to be before they actually buy it and bring it into the plant and use it. Our other prices, like class 3 and 4 and a portion of class 2, is actually priced after the fact. So we've already taken the milk in, we've made cheese out of it, and then a few weeks later we get the bill that says, well, this is what you have to pay for milk. There are a lot of people that are saying, pick a lane. Either everybody gets advanced pricing or everybody has to pay after the fact or something else, but we could stop some of this negative PPD problems perhaps by thinking about timing. So those are the few issues I wanted to talk out or throw out for us maybe to discuss a little bit. But I think that it behooves us to maybe go back in time a little bit and, after a poll question, have Andy talk a bit about the structure and why we got to where we are.
Sure. Yeah. Let's turn to Andy and talk a bit about what that first poll question was. And 38% of people thinking that federal orders are going back to the 1930s. Can you dive into that a little bit and kind of explain maybe a few of these things that Mark was talking about?
Yeah, I'll try to do that. I'm going to just start out with a little preface. We live in a world where people are often wearing a hat or a shirt that sort of proclaims what tribe they belong to and what they believe about one thing or another. I'm pretty sure Mark and Chris would agree with me that, of course, we have some opinions about federal milk marketing orders in general and different provisions in particular, but our job isn't to persuade you to what we think about something. Our job is to help you better understand what's going on and formulate your own ideas with as much clear information as you possibly can. So I'm positive that in this episode and in future ones, we're going to say something where somebody's standing up clapping and somebody is grumpy, and then we'll say something else and you're going to wonder whether I'm for it or against it. And I'm just going to start out by saying I'm not for it or against it. I'm for dairy farmers. I think you guys need to sort out what makes sense to you. But I can tell you what I think and what I understand. And one of the things that strikes me is it's very common when you reach a point, especially when prices are horrible, where you just kind of blame something for resulting in this market price. And when you have a government agency every month putting out a piece of paper where one line on the bottom says, this is the price of milk, it's not too surprising that you kind of want to step back and go, well, why the heck didn't they pick a better number than that? That number is horrible. And I think we need to understand, where does this stuff come from? And what was the purpose? And what are we trying to do? That poll, in the late 1800s, yes, 1800, the 2 centuries, if you want to think of this one as a century already, we had cooperatives in the New England area, the states around Boston, that were trying to figure out how can we get farmers a better deal for their milk that they were selling. And they cooperatives in that area came up with the idea of, why don't we charge the fluid milk guys a different price than we charge other people, the manufacturers, the cheese makers and the butter makers? And basically they knew that the fluid guys were able to pay more, were willing to pay more. They didn't want to pay any more. That would be an unnatural instinct for a buyer. But the key to that working was that consumers, the ultimate final purchaser of that product, was not insensitive to price, but less sensitive to prices than, say, somebody buying cheese. If you're buying milk for your family, of course you want to have the lowest price possible. Anybody would. But if the price is a little higher, you're not going to say, well, to heck with that, I'll just get more juice, which, oh, by the way, wasn't so easy in 1896 Boston either. So there was this intuitive understanding that maybe you could leverage the nature of the marketplace to charge a little higher price on the fluid side. That was the beginning of classified pricing. Well, okay, so you're going to charge this guy that price, and you're going to charge this other guy another price. And at the end of the day, you got to sell all the milk. And so that means at some point, you got to take a price that will just make sure that all the milk has a home. And so you charge what you can, you push as hard as you can on the fluid side, and you take what you have to on some other side, maybe the butter powder market or what have you. But that also means there's some farmer that's selling his milk to the fluid guy, and there's some other farmer that's selling his milk to the cheese guy. And if you make this price difference, that means one guy would get a really high price and one guy would get a low price, and that doesn't feel right either. So the concept was, it's again within the concept of a cooperative, let's share the revenue. Instead of saying you sold to the fluid guy, so aren't you lucky you get this high price? Say, well, we'll take a little bit of your money, we'll mix it in with the money of the guy that got the low price and pay everybody kind of an average. That's pooling. Classified pricing and pooling started 40 years, 2 generations before it became a government law. In 1933, we passed the Agricultural Marketing Agreement, the Agricultural Adjustment Act. That was the first farm bill. And we had a little language that kind of opened the door to marketing orders. It didn't really quite click. We spent the middle of the 1930s trying to figure out how to do it better. And then in 1937, we passed the Agricultural Marketing Agreements Act. And that's generally considered the founding legislation that gave us the federal order system that we have today. I think it's a couple of things are really important to note. None of us, I don't think any of us remember Franklin Roosevelt saying this in real time, but when Roosevelt became president, he invited people to bring forward ideas because we needed to do something that we hadn't done before. There was almost no government regulation of economic markets prior to Franklin Roosevelt. And with the Depression and unemployment and all these problems, he was looking for ideas. The dairy industry, largely led by cooperatives, came forward and said, we've got an idea that we think is a really good idea, but the problem is we can't enforce it. If you would help us and make this like a law and use your powers as a government, we think this could really help our dairy farmers. So yeah, what is that? That's called classified pricing and pooling. In 1937, there were 60 city markets, mostly in the kind of eastern half of the United States, from Minneapolis to Boston, that were using some form of classified pricing and pooling that was operated by the cooperatives. And they said, look, we got this system, it kind of works, but we can't verify the prices. We make this agreement and sometimes people don't follow the agreement, but oh man, if you can make this a government law, whew, boy, that'd be way cool. And then, it would really work. Well, it took quite a while before this really got its cleats in the dirt. But indeed, one of the things that the government brought to this was auditing, verification, and enforcement, penalties. If you don't do what the regulation says you're going to do, there's important consequences. The system grew very slowly, and originally, certainly in the late 1800s, but even up into the first half of the 1900s, you had a dairy industry in New York, you had a dairy industry in Wisconsin, you had a dairy industry in California, you had a dairy industry in Georgia, and everybody knew that, but nobody really thought that what happened in the New York City market really made any difference to what was going on in Chicago or Los Angeles or Dallas or Tallahassee. It was like, you got dairy industry? Oh yeah, we go in too. But it wasn't like they felt all that connected. Price goes up in New York. What the heck does that have to do with what's going on in Milwaukee? Over time, of course, markets became more connected. You see that in your own life. Those of you who are, my age or close to it, have witnessed this change that just comes about by the fact that stuff moves around so easily now. Transportation is so improved, etc. And now we have a sense that there is a connectedness, that what happens in New York does make some kind of difference to what happens in Michigan and so on and so forth. And so this has led now to more concern about coordination. People in Wisconsin care about what the price of milk is in Florida. People in Michigan are impacted when Pennsylvania and New York have a surplus, etc. And so this coordination activity has now become sort of the fifth thing that government agencies start to do. And one really a strong example of that was the 1961 date that was on your poll. 1961 was the date that the MW price became the reference price, the starting point, the thing that all other prices were built upon in the Chicago order. And over time, about 10 years, early 1970s, eventually the MW price became the starting point for every price in every milk marketing order. Prior to that 70s, every order had a different starting point. Everyone, I got the Midwest condensatory price, and I got this thing, and I got that thing. And now, since that 1970s time, there is this much stronger sense of this is a national market, a national system. It's somehow connected. And, we've got 10 orders. Before we had 10 orders, before Congressman Steve Gunderson of Wisconsin badgered USDA into condensing the number of orders, we had 33. In 1962, we had 81. How big should an order be? How big should an area should milk be pooled? That's an open question. But we still have regional markets delineated, but we have a sense of this interconnectedness. Okay, let me talk a little bit about sort of why it's set up the way it is. In my mind, there can be no question that the reason why cooperatives in the Northeast instituted this system in the late 19th century was they wanted to get their farmers a better deal. They wanted to get more money for their farmers. Were they interested in making sure that fluid milk got to consumers in the cities of the East Coast? Yeah, of course. But I mean, the whole point was pay me for this. Pay me something that I think reflects that value. When it comes to the federal government, federal government wants to help out farmers, but they also got other people they got to think about. And when you read the Agricultural Marketing Agreement Act, it says we want to give farmers the best price we can. And they talked about parity prices, which was an old concept about a fair price that helped you cover your costs. But the second paragraph says, but, we don't want to be too tough on the consumers. Remember, we're talking about the Depression. It was tough for everybody. And so you got to balance between farmers and consumers. Note, by the way, nobody really cared that much about processors, but there was this kind of, we got to have some kind of balance. They want prices high. These guys want prices low. What's the right place? The third paragraph says, and we don't want to mess up trade too much. So there was this recognition that kind of the boundary on how much you can help farmers is to what extent does a higher price mess up your sales? Do you get people pushing back saying, oh boy, and then you end up with a surplus and we don't want that. And so there's this delicate balancing act, and the federal government actually by law is obliged to try to find some kind of balance. And for this reason, USDA has always wanted to have some kind of external reference point. The MW, as Mark said, was milk that was ineligible to be under federal orders because it wasn't grade A. So it's outside the system. We kind of ran out of grade B milk, and so now we're looking at cheese and butter and powder and saying, well, that's outside the system. It's not even milk, but can we use that as kind of a template, a benchmark? If it goes up, then the price of milk can go up. If it goes down, then maybe it's not the best way to do it, but the idea is, how do I know what market conditions are? I can't just make it up. So can I look at something else? And I think, as Chris is going to get into, this notion of reference prices is really critical in how we operate orders. There's issues of fairness. Big one that farmers think about is fair between me and my buyer. But federal orders also justify themselves by saying it's fair for processors, because if I'm a cheesemaker, I kind of like knowing that my competitor is facing a similar price to what I'm facing, or if I'm a fluid guy or whatever kind of guy I am. So buyer to buyer fairness, farmer to farmer fairness. You folks in places where the blend price is low always kind of wonder why it's fair for farmers in places where the price is high. But nevertheless, your neighbor and you are going to have pretty similar prices. I mean, it's going to differ by composition. It might differ by transportation costs. Maybe you belong to different co-ops and you got different other things going on. But basically, you're looking at playing from the same rule book. The third-party auditing is critical, But it's not just third-party auditing. It's the fact that the guy that's doing the auditing is the government. And so that not only can they look, but they can kind of make sure you tell the truth. And if you don't, there are consequences. So fairness, level playing field, trying to get a good deal for farmers, but realizing that there's some practical limits on just how far you can go. I think those are undergirding ideas for why we ended up with classified pricing and pooling. Could we get higher prices with federal orders? Well, maybe, but the thing of it is, if you push up on one part of the market, you kind of end up pushing down on the other part of the market in order to make sure all the milk clears. If you don't do supply controls, that's going to be the discipline. You got to be sure you want to sell every pound of milk. You don't want to walk up to some farmer in Idaho and say, oh, sorry, we ran out. You're going to just have to keep yours. What's fair to a consumer? I don't know. But this kind of market balancing seems to be a way that we've reconciled how to do that. Are all the details right? All the individual rules right? I don't know. But those are things that certainly we can talk about that stand apart from whether or not you want to play the game with a referee, which at the end of the day is, I think, probably one of the biggest features of federal orders that we should be keeping in the back of our head. Caitlin, back to you.
Thank you, Andy. We will go to one final poll question before we turn to Chris, if Jim wants to put that up. When you use a dairy revenue protection contract, what prices can you protect? Class 3 or 4, protein or fat, all milk, your blend price, or all of the above? We're about split between all of the above or class 3 or 4. Very few in between. We can go ahead and close that now, Jim, and I will let Chris talk about these results a little bit. And how else federal orders contribute to a reference price and price stability in terms of risk management.
Thanks, Caitlin. I'm glad to be here. So as Andy talked about there, right, there's kind of like 5 functions of federal milk marketing orders: classify milk based on how it's used, set minimum prices for those different classifications, pool the revenues, and make some assurance that everybody gets kind of an average price, at least as a base price, audit the prices and quantities, and then coordinate across the different milk marketing orders. So kind of as a consequence of doing those different functions, one of the things that I think gets underappreciated a lot of times in these discussions about federal milk marketing orders is the information that they provide, right? So because all of the milk that goes through the pool, we know how much, we know what it was used for, we have some idea of the minimum prices that gets used. Everybody kind of starts from the same starting point for any negotiations or bargaining. Doesn't matter if you're a part of a co-op or not part of a co-op, if you're in a marketing order, or you're part of a big co-op, or if you're part of a small co-op. And when we used to have over order premiums, for example, those would start by definition as an add-on, right, to a classified price. So I think that information kind of aspect tends to get overlooked. The other thing that was kind of been referred to with the previous question is the role that the federal milk marketing orders play in risk management that we have today in the United States for dairy farmers by providing neutral, transparent, timely, publicly available prices. Okay, so the class 3 price, which of course is milk that's used for cheese and dry whey, is traded on Chicago Mercantile Exchange. And actually, I guess the original futures markets in this country back in the 1890s, about the same time, Andy, right? 1890 something, was a butter and egg exchange. So dairy was part of, kind of initial discussions in this country, but then we didn't really have futures markets for a lot of different reasons. And then in the early 1990s, I think the first one in the modern era that was reintroduced was 1993, I believe. and it was a fluid milk contract. But there were some issues with it. The most important ones were that it was fairly thinly traded, which we might expect with a new contract that's just starting. But the problem with it being thinly traded was it was deliverable to Madison, Wisconsin. So if you couldn't get out of the contract, if you couldn't take the opposite position, then you had to find a milk truck to go to Madison. And that was back during the time before we had the BFP and then got to the classified pricing. And now you see the action on the futures markets is in largely class 3, although to a certain extent class 4 also, and then some of the other products that underlie the fat and protein. But so one of the things that I think we should also appreciate is that this class 3 price and class 4, by having an understanding of by using these national surveys to get an idea of how much and where and when and things like that, we set this reference price that we can all use. There's a lot of other countries that have been struggling in recent years to figure out some market-based risk management products. And one of the primary reasons that they're struggling is that a lot of these places don't have a common reference price. They have a bunch of different prices depending on where it is, but everybody's not on the same page. And the government here is uniquely situated to be an unbiased, comprehensive collector of this market information and provide this. And so that's why we see things like dairy revenue protection, where you can do class 3 or class 4, or you can do fat or you can do protein. And LGM dairy also using this class 3 price. So I think that that's something which doesn't mean it's perfect, but actually when we do surveys, especially with producers or with consumers, what you'll often hear is that they don't want government to do things, but then when you actually start looking at what are the alternatives, government is the worst except for all the other alternatives. And so that's what they end up preferring, especially when we're looking at certifying and auditing and things of that nature, as Andy just talked about.
Thank you, Chris. We are going to open up our discussion for questions now. Our audience members can submit questions in the questions panel there on your GoToWebinar control panel. We'll start with this question, which is kind of all three of you touched on a little bit. In a perfect world, what do you feel would be the best way to discover a price for milk products? Totally off the top.
Okay, I'll throw my hands up. I'm an economist. So I would use this thing that we call, supply and demand. And we've done that in the past, and there are other places where that does happen. I mean, clearly, markets are going to determine what the value is for milk. What we're trying to do with regulation is to say, is there some means in which we can determine where those supply and demand lines that are ethereal, that are not perfectly known, actually cross? I mean, that's what we did with that MW price. We let the market figure it out for a very close substitute product, grade B milk. And we said, good enough, let's use that as the benchmark. But we don't have that anymore. So, that would be one alternative. There are only a handful of things that are really possible. Product price formulas are one of them, in which we say we need to go up the marketing chain one level where we don't have regulation. And that's wholesale dairy product prices. And oh, by the way, for those products, we do have a daily spot market at the Chicago Mercantile Exchange where we can observe those prices. And many companies have contracts for their products that reference those spot prices. And so it does work its way back into a very high correlation between those survey prices that are conducted weekly across plants and the spot markets. So, using product price formulas is really also using those market values, but just moving up the supply chain one link. That's one possibility. Another would be administrative pricing. That's where you've got some board or small panel of folks that try to understand market fundamentals and come up with an idea about what they think milk is worth. We have countries that use that kind of system for pricing. And although there are lots of variations on a theme, there aren't very many fundamentally different ways in which we could price milk, in my opinion.
Okay, I want to tell a short story and make a couple of points. I was at a conference a number of years ago, and we had an international panel, group of people from different countries who were in the dairy industry talking about how stuff works in their country. And there was a fellow there from Germany that worked for the large German dairy cooperative. And one of the panelists, one of the members of the audience, also worked for a substantial dairy cooperative in the United States, said, Miracle, could you just kind of go over again, how do you set the price of milk? He goes, I'm sorry, what did you mean? He said, well, like, what determines the price of milk for you? He says, well, we get milk and we make dairy products and then we sell them and then we cover our costs and then the money that's left over we give to our farmers. And I was like, oh, wow, what a system, huh? And this is kind of what Mark is talking about. This is supply and demand. And an economist, a classical economist would say, well, if you didn't like Miracle's price and somebody else is paying more, go see if you can get with that guy. And the experience in the United States, again, admittedly, this is pretty historical, but there's even some modern examples, is that kind of system makes farmers feel like they're racing to the bottom, that they're undercutting their neighbor, trying to get into this market, and the only guy that's really coming out is the processor. That might be unfair. That might be just a description of the way markets work. But that would be a concern that I think a lot of folks would raise. Am I able to represent myself well in a bargaining position with a buyer? If I belong to a big co-op, does that help? Can they do a better job than I can do individually? The other thing that I will observe for you is in the early part of the 20th century, there were a group of processors in the New York metropolitan area who got together every week and convened what they called the Committee on Values. And at the end of that meeting, they would notify a reporter for a farm magazine that the Committee on Values had determined that the value of milk for this week was whatever, 7 cents a quart or some number. Well, basically, these guys were colluding to set the price of milk and telling somebody so that farmers could get ready for what was coming. Part of the point of that is, yeah, they wanted to collude, but also they wanted to make sure they all had kind of the same price. The first cheese exchange, well, there were two, actually. One was started in New York, in Western New York. One was started a little bit later in Plymouth, Wisconsin. And this is where cheesemakers came together to trade some cheese, and they would look at that price in the Cuba Hotel. Cuba is the name of the little city in Western New York, or out of Plymouth, and they'd say, oh, this is the value of cheese. The point of this story is both farmers and buyers want to have some kind of reference. They don't like being cowboy on what the prices are. And so I think we have to understand that when we think about what's a better system. If there were no government regulation, I'll tell you what, I think the value of the exchanges, the importance of exchanges would just multiply, because people would want to have some sort of external reference point on what stuff is worth. And unless you want to get back to shipping milk to Madison, it's kind of hard to figure out what a spot market for milk looks like.
Thank you. This question is very timely and focused around, obviously, this year has been a complete new thing for everyone. And this question says, are all the issues that we've been talking about just a knee-jerk reaction to a short-term problem, or are there things that we can learn from this year to improve milk pricing in the future and in more stable times?
I'm going to throw out a couple of things, and I know that, this is going to be like dragging a lure in front of a well-fed pike. It's Andy's going to have to snap at it anyway. So I'll do it. Fundamentally, federal milk marketing orders are and were built around fluid milk. We need to make sure, that fluid milk is the thing that must be priced. Fluid milk processors are the only processors who have no choice in whether they're regulated or not. They can't decide to depool this month. This is a matter of farmers in the region voting and deciding that, yes, indeed, they are going to be regulated because we have a federal order. Everybody else, it's an option. And so, we have this system in place that is fundamentally a fluid milk marketing system, and manufacturers get to kind of come along for the ride. They help provide services and grease the skids for sure, but we have a fluid milk system in a manufacturing world. At the time that federal orders were conceived of and formed, fluid milk was probably, well, if I remember my slides correctly, maybe 65% of the volume of milk in federal milk marketing orders. Today, it's less than half of that. So, it's a different kind of issue and mechanism in place. So I think that's something we have to consider as well. It's not necessarily built for the problems of today.
Sure.
Yeah, the thing that I would add is I think this year, more than maybe any other we can think of any time recently or historically, has reminded us that the outliers are important. I can't tell you how many times in my 40 plus years of career, somebody would come up with this idea for changing something. MW is broken. Let's use wholesale prices for 4 commodities to figure out the value of milk. And inevitably, they'll say, okay, well, let's put together this little spreadsheet and a formula. And let's imagine if we would have had this 10 years for the last 10 years. We plug in all these prices and we say, well, how does that compare to what we actually had? And you go, oh gosh, look, it's pretty close. We did that when we said, let's do the average of class 3 and class 4, which, is now giving us part of the reason why we're getting this gigantic negative PPDs. We've done this. We did this when we did the MPP. Oh, wow, we'll calculate this all milk price and we'll throw in a couple of inputs and take a look at that historically. And yeah, it's looking good. On average, it's fine. Well, yeah, okay, on average, it's fine. The trouble is you don't have the average every month. And in 2020, we not only didn't have the average every month, we had like these amazing differences between the high and the low. And we found out that our thing that works pretty well on average kind of sucks when you got outliers. And I think maybe you just say, oh, well, it's a roll of the dice. You don't have outliers that often. But I got a feeling we're going to probably think a little bit more about, are we okay with a system that works good on average, or whether or not we need to do something that moderates the tails or somehow deals with those issues. But that's part of our challenge, is to not just look at something and say on average it's okay. And boy, the pandemic economy made that really clear.
Sure. This question comes in, what can we do to help those with extreme negative PPDs? This person says, as I understand, DMC does not cover PPD. I don't know, Chris, if you want to talk about that.
Well, I mean, that's true. I mean, DMC uses the U.S. all milk price, right? So it's an average across the country. It's not, and it's dealing with the all milk price, which is kind of related to the mailbox price in most places, but not necessarily, right? And it's been part of the issue that we've been having this year is that some of these effects are really very specific to the co-op, specific to the region, or even specific to the farm, right? And that instrument doesn't deal with that. What can we do about that for the negative PPDs? The thing about the negative PPDs, as Mark and Andy talked about, is there's multiple causes, right? The spread between class 3 and class 4, as Andy was talking about, the depooling that Mark was talking about, and with the depooling, those revenues go somewhere. So it might be the case that some farmers that are delivering to the places that decided to depool end up better off. But that means that there was less money going into the pool, so everybody that's still in the pool is much worse off. And so, then for that issue, what are the qualifying? What are the repooling rules? If you decide to depool, how much can you? How hard is it to get back on there? And we do have some differences across the country in qualifying and qualifying milk. The Northeast is different than the Upper Midwest, for example, right? So, and maybe Andy or Mark wants to say more about that.
Now, I guess one thing I'd throw into this is having a class 3 price that's higher than the blend or higher than class 1, which we've seen, of course, is one problem. Depooling is a different problem. If you had this inversion of prices where class 3 is the highest one, but you had mandatory pooling, that would really change how your blend price looks. Might not change it hugely. It kind of depends on what the guys that depooled end up deciding to pay you. But there's two different things going on here, the depooling thing and the price thing. The other thing is you kind of want to really think about just how upset you want to be about a negative PPD. I know when you see a big negative number on a milk check, that's disconcerting. It's like, that's wrong. But imagine if I just said, okay, we're going to start out every month with a $50 milk price. That's just going to be where we're going to start. And then we'll see how much of that $50 we can actually pay. And every month we'd find out, oh gosh, we can't even get close to 50. When we start out with a blend price in the orders that do multiple component pricing, we start out with class 3. And we assume that on average, that's going to be lower. And we found out, oh, it's not always on average. Sometimes it's higher. And then you got to take money away from that price because you didn't have enough money in the pot to begin with. Well, okay, that's annoying, but it's just because you made your first guess wrong. That wasn't a good guess. You didn't have enough money to pay that price. And it's kind of an artificial guess in some ways. It's a starting point. But at the end of the day, the money you got to pay for milk is the money in the total pool, period, the end. And it's just a question of figuring out how you divvy it out.
Sure. We'll go to this. This question asks for a specific 100-weight example of how class 1 is priced and how this would play out for class 3 and 4. They're looking for an example of how that would work.
I nominate Mark.
Thank you. Well, class 1 is priced fairly simply, but it's based on the average of the class 3 price and the class 4 price plus 74 cents, plus whatever the relevant class 1 differential is in the area. So you really can't start with class 1 and back into class 3 and 4. You're starting with class 3 and 4 and you're building up to class 1. That's kind of the way the system works here. And in some of our orders that are heavily class 1, they don't pay based on components. They pay based on skim milk value and butter fat. So it can be a little bit different, what farmers are paid for, but the total dollars are generated in the same way in all parts of the country. Class 2 is the confusing one because, with class 2, what was that, Andy?
I just said they're all kind of confusing.
Okay, they're all kind of confusing. I'll agree with that. But with class 2, we do have a differential in there too, but it's static. It's the same everywhere in the country. We add 70 cents to the values. And we get values out of butter fat and out of skim milk. One of them is advanced price and the other is priced after the fact. So that's the one that's a little bit more confusing, I think, for folks.
Sure. This question is separating farms and milk here. They're asking, is most of the milk that is being sold at a profitable level, or are most of the farms selling milk receiving an unprofitable price? And this is resulting in complaints about the pricing system. Which is a
I know I'm
bit
going to interest that one.
Yeah, that's a Chris Wolf question.
Thanks. Well, not to be pedantic, but it partly depends on what you mean by profit. I mean, you can't, over the long term, consistently sell milk below what it costs you to produce, or you're eventually, going to be out of business, which sadly is what happens. You can do it for shorter periods of time, but what tends to happen on dairy farms is that when times get tight, they tend to underpay what economists would call the unpaid factors, right? So they tend to have very low returns to their own management, their own labor, and the capital they have invested in it. If I'm doing cost of production, I'm gonna, look at what their variable costs are and their fixed costs, okay? But I'm going to make certain that they get a return on equity that is at least 5%, and I'm going to make certain that they get a return in there for all the time and effort that they put in, both them and their unpaid family members. And so you do see when it's a bad year that there are people, and sadly, that are losing money, sometimes losing below variable costs of production. But the first thing they're doing is underpaying themselves, and that is happening. But there's also friction getting in and out, so it's not something we can do. That's another reason why it would be good to have a more predictable and less uncertainty on your milk price, so that you can make decisions long term about whether this is the best use of your time and your money, and whether you're going to long term be part of this industry.
Sure.
And I think, Chris, it's also important to point out, it comes as no shock to anybody that not all farms have the same costs of production. But in fact, I think the thing that does shock people is how big that spread can be between, folks at a high cost quartile and those at the lower cost quartile. It may be as much every year, we see in our farm financial records as $10 a hundredweight. So this is why you can look at this and say, there are people that have gotten through this okay, and there are those who have not. It's also why you find people, I think, like we had on the live stream last week before, who were talking about risk management, and they said, you know what, I'd rather have a lot of singles. Let's get on base, and protect some level of profit rather than trying for home runs all the time. So those folks are trying to make sure that they're safe and in business for the long haul.
Yeah, and the question was framed as number of farms, but of course it's also the amount of milk. Economics works to make sure there's enough milk that gets to the market, to clear market, so you got just as much as you're buying as you're selling. They don't really care. Markets don't care how many farms there are. It's based on the milk. And I don't remember, Mark, we don't really have great data for this now, but something like 2/3, 3/4 of the milk comes from 5% of the farms, or something in that ballpark. Would you agree?
Oh, yeah, it's a very large proportion that's coming from our largest dairy farms now.
Mm-hmm.
Yeah, and so those guys are not bulletproof. They're not invulnerable, or they don't have. It's not like they never have a bad year, but by and large, that milk is profitable, and there's always going to be guys at the edge that aren't as profitable, or even losing money. But it's really the conundrum between the economics is around getting milk to the market, not about saving farms. I'm sorry, but that's the way markets work, and the answer is really quite different. How much milk is making money versus how many farms are making money.
We're getting a lot of questions about depooling, which of course we will probably dive a bit deeper into in a future episode. But the one I'll ask now is, do processors currently have to commit to participating in pooling for a certain set length of time, like 6 or 12 months, or would a commitment like that help control negative PPDs?
Well, the discipline that we have now in federal orders is different from one to the other. In a place like California is a good example. I think you just have to blink, and you can be in or out of the order. It doesn't take much. It's a very low hurdle there. But then again, there's a lot of milk relative to the amount that is needed to service Class 1 markets. The same is true in the upper Midwest. We have a relatively low hurdle for getting in and out. If you take a look at something like the Northeast, as Chris pointed out, the hurdle's much higher there. And it's not so much that you have to make a commitment to be in there for a longer period of time. It's that they're only going to give you a relatively small window of opportunity to make that decision to be in the pool. So if you get out of the pool tomorrow, which you can do, you may not be able to get back into the pool for 8 or 9 months, and you may lose the opportunity when it would be advantageous for you. So people are kind of weighing those costs.
Sure.
Yeah, and I think also mandatory pooling would not change the fact that you had a negative PPD. What it would do is it would keep that high Class 3 price in the pool. And so it would benefit the blend price. It would benefit processors who had a lower value. They would get a higher equalization payment, but you'd still have negative PPDs. It's just the money would stay in the pool instead of being pulled out by whoever was at depooled, usually a co-op.
Sure. We will do one final question here to kind of summarize everything. What is the interest level, or is it growing in the industry to really make a significant effort to modify the federal order system? Kind of a loaded question, but.
Yeah, you're probably sick of me saying all this stuff, but I'm going to say, I think, I've said this for years, if you walked into any room in the dairy industry and said, raise your hand if you think federal orders could be improved, everybody would raise their hand. They'd stand up. It would be clear. Everybody thinks there's something that could be better. Once you start going, how about this? How about that? How about this one? Then you got 2 people over here that like this, 7 people over there that like that. That's the trick. And if you're the United States Department of Agriculture and you hear all these people saying fix federal orders, they're going to say, if you have any kind of like a particular way you'd want to fix them, and can you agree on what that one way is? If you can, we'll talk.
Anything to add?
Yeah, it's there is, I think, building tension for having a federal order hearing. But as I mentioned, federal order hearings also have something that's called the scope of the hearing. In other words, how much of a series of problems are we willing to listen to at this point in time? If that scope is really narrow, we're going to try to fix one little aspect of it. But I think we've got, like Andy said, everybody can raise their hand and say, I think there's a problem here. We may not agree on even what the biggest problem is at the point in time. Our hearing scope may have to be fairly large. If it's large, it's complicated. Remember back to that 1998-99 time period when we had the national hearing held in different places around the U.S. To take testimony. I don't remember what the poundage of pages were that were generated from the testimony, but oh my gosh, this is complicated. It takes time. There'll be a vast amount of effort and cost that gets put into a major federal order reform. I'm not saying it isn't needed, just that it's something you don't do quickly and lightly.
Sure. Well, thank you, Mark, and thank you, Andy and Chris, for joining us today on our Hordes Dairyman Dairy Livestream, sponsored by Diamond V. We want to invite everyone to join us for our next Dairy Livestream. Will be December 2nd, right back here, same time, same place. We did get a few questions that we didn't get to today. Hopefully, we'll get to dive into them in some future episodes. We thank you for your time and for your questions, and have a great rest of your day.